Silver just closed at 93.66, up 6.23% in one day, and the story behind that move is not what the price chart is telling you. Today is Saturday, February 28th, 2026. Markets are closed, but Friday's session, February 27th, dropped a vault report, a macro data shock, and a set of physical market signals that we need to lock in before the next trading week buries them under noise. In this video, I'm going to show you three things: how 5 Comex vaults scrambled to stuff metal into registered at maximum urgency, while 4 other vaults quietly drained metal out of the entire system; why the silver swap rate sitting at negative 2.8% and inverted for 4 straight months is the loudest alarm this market has seen since the Hunt brothers; how Shanghai and Washington just told you on the same day that physical silver is scarce, stagflation is here, and paper pricing is losing control. We are going to start in the only place where the truth cannot be spun, the vaults. Segment 1, the price move everyone saw on Friday, February 27th. Silver closed at 93.66 bid, 93.91 ask. It was up $550 on the session, a 6.23% move in a single day. The intraday high was 94.27, the low was 87.75. Gold closed at $5,278.20, up $94.30, about 1.82%. Those numbers by themselves already tell you silver is leading this phase of the move. But Friday was not just a big up day. 3 separate engines that each move silver on their own hit on the exact same calendar date: Comex silver options expiry, first notice day for March futures delivery, a hotter than expected producer price index report that slapped rate cut fantasies back into reality. Any one of those can bend a session. All 3 hitting together with a fresh CME depository report underneath them is not random. It is a pressure test. Now we go under the hood. Segment 2. 5 vaults rush to load registered Comex. Publishes metal depository statistics every business day. Warehouse by warehouse, registered versus eligible, change from prior session. Most traders never open the file. That is their mistake. The report dated February 27th, covering activity on the 26th, is one of the clearest single-day stress prints of this entire cycle. 9 separate silver depositories show activity. 5 of them were doing one thing: shoving metal into the registered bucket as fast as possible. First, Asahi Refining. 824,168 ounces moved into registered status. That is the largest single vault level addition in the entire report. Asahi is not just a warehouse, it is a vertically integrated refiner. They can take silver straight off the production line, assay it, slap a Comex warrant on it, and drop it into registered without waiting on anybody. To see 824,000 ounces mobilized into registered on the eve of first notice day tells you one thing: someone decided the deliverable pool needed reinforcement immediately. Second, Loomis International, 964,465 ounces were reclassified into registered. That is the single biggest individual adjustment in the report. Loomis is pure logistics and custody. They do not own the metal. When almost 1 million ounces move from eligible into registered there, it means beneficial owners, real institutions, sent explicit instructions. Warrant my bars. I am making this metal available to fulfill futures delivery. At the very last window before first notice day, nearly 1 million ounces were thrown into the deliverable pot. That is not passive, that is an urgent build. Third, StoneX Group, 3,700 ounces added to registered. StoneX only got Comex depository approval in April 2025. It is the newest vault in the network and the only one operated by a non-bank FCM. The fact that even this fresh facility is being tapped tells you the system is using every available lever. Fourth, Brinks, 111,428 ounces added to registered. Fifth, Delaware Depository, 85,768 ounces moved into registered. When you add those 5 together, total registered silver rises to 88,423,729 ounces. That is an increase of about 1.13 million ounces in a single report. On paper, it looks like registered up, problem solved. That is the lie the headline number tells you. The truth is in what happened at the same time. Segment 3, 4 vaults quietly drained the system. While those 5 vaults were frantically loading registered, 4 other vaults were doing the opposite. Metal was walking out of the Comex ecosystem entirely, not moving from registered to eligible, not reclassifying, leaving. JP Morgan, eligible silver fell by 647,661 ounces. Those bars did not become registered. They are gone from JP Morgan's Comex custody. CNT, coins and things. 485,175 ounces withdrawn. This is one of the biggest U.S. precious metals dealers and a major supplier to the U.S. government. Malca Amit, 128,731 ounces out. MTB, Manfra, Tordella, and Brooks, owned by MKS PAMP, 192,764 ounces out. Combined, about 1.45 million ounces physically exited the Comex warehouse network across those 4 vaults in a single session. Now read the net picture. Registered silver up 1.13 million ounces because 5 vaults were rushing to load. Total silver down by roughly 306,000 ounces because 4 vaults were seeing exits. The system gained deliverable inventory by converting and warranting bars. At the same time, it lost physical metal because some big holders chose to pull silver out of the Comex world entirely. Both things happened in parallel and at scale. That is not chaos. That is order under stress. Everyone is acting rationally for themselves, and together they are painting a picture the price alone does not show. Segment 4, the swap rate. Paying to borrow metal vault reports are one lens. The second lens is the silver swap market, and it is screaming. On February 25th, the 1-year silver swap rate stood around negative 2.824%. Here's what that actually means. A silver swap is a deal. One party hands over physical silver and receives dollars. At the end of the term, often a year, they get their silver back and return the dollars, plus or minus a rate. In a normal market, the rate is slightly positive because the guy giving up dollars is surrendering cash that earns interest. The guy receiving dollars is taking on storage, insurance, logistics, and physical handling risk. In 2023, the average swap rate was slightly positive. In 2024, it was only mildly negative. Now it is almost minus 3%. And it has been inverted like this continuously since the first week of October 2025. Operationally, that means this. Someone with serious size is willing to pay nearly 3% per year for the privilege of holding physical silver right now, even though they have to give that silver back in 12 months. They are paying to borrow metal, not money. They are explicitly pricing in a belief that sourcing physical silver a year from now will be tougher and more expensive than sourcing it today. And the classic free money arbitrage, borrow silver, sell it, invest the dollars, and buy back later, is not being done at scale because the step that looks trivial on a spreadsheet, finding the metal, is not trivial in the real world. In December, the 1-year swap rate minus US short-term interest rates blew out to over 7%. The only comparable reading in the historical data comes from the late 1970s, 1980 Hunt Brothers episode. Back then, lease rates topped 7%. Backwardation persisted for 11 weeks. Today, this inversion has already lasted over 4 months. On duration, it has surpassed anything in the last 46 years. That is not an opinion. That is the market loudly saying, I do not trust future paper promises to get me metal at today's prices. Segment 5, carry-adjusted backwardation, immediate metal more valuable. Now connect the swap market to the futures curve. Recently, the raw spread between March and May. Silver futures showed March trading about 65 cents above May. That is nominal backwardation, near month more expensive than the deferred month, but you cannot stop at the raw spread. You have to adjust for financing costs at today's interest rates, storage, insurance. When you do that, the carry-adjusted basis comes out slightly negative, around minus 0.07. In plain English, after you include every cost of carry, owning silver for immediate delivery still costs more in real terms than holding a paper claim for later delivery. And that has not been a one-day blip. Carry-adjusted backwardation has been present continuously since October 2nd, 2025, the same point where the broader physical stress narrative really accelerated. The market has been repeating the same calculation day after day. We cannot arbitrage away the premium on physical silver at a profit. The curve is not hiding the scarcity, it is publishing it. Now we have vault data showing metal leaving the system while registered is being desperately topped up. A swap market inverted for months. A carry-adjusted curve saying immediate metal is more valuable than future promises. That is 2 independent physical signals and 1 derivative signal, all pointing in the same direction. Segment 6, Shanghai's second intervention. China throws up fences. The third signal fired from Shanghai. On Friday, February 27th, the same calendar date as Comex first notice day, the Shanghai Futures Exchange implemented a new rule package targeting near-term silver futures positions. The intention, in plain language, protect China's critically low physical silver reserves from being overwhelmed by speculative domestic paper demand. This was not the first move. Earlier in February, Shanghai restricted 23 accounts for exceeding position limits, cut delivery allocations to 0 for investors operating without approved hedging quotas. Now they have added a broader policy framework for silver futures risk. Layer that on top of China's export control mandate from January, which requires government licensing for all silver shipments leaving the country. Put it together, and you see the strategy. China controls a majority of global silver refining capacity. They are now restricting what can leave the country. They are restricting what domestic paper contracts can claim against internal inventory. For Western markets, that means Chinese refined silver that used to be a potential emergency source for Comex registered stocks is being walled off behind policy. On the same day Comex started delivering the most physically stressed March contract in modern history, Shanghai pulled its fences tighter around its own silver. The two exchanges do not share motives, but the calendar overlap tells you how globally synchronized the stress has become. Segment 7, Stagflation, PPI shock, falling yields, and why metals ripped. Now zoom out to the macro picture that hit at 8:30 a.m. Friday. The U.S. Bureau of Labor Statistics released the January Producer Price Index, headline PPI, up 0.5% month over month versus 0.3% expected. Core PPI year over year, 3.6% versus a 3.0% forecast, a 60 basis point upside surprise. One of the biggest contributors to the miss was a 14+% jump in professional and commercial equipment wholesaling margins, corporate America quietly passing costs through the system. Fed Governor Christopher Waller had warned on February 23rd that this PPI print would heavily influence the Fed's preferred inflation gauge, PCE. The market did the math quickly. Expected rate cuts for 2026 compressed from 4 to roughly 1 or 2. The first fully priced cut slid out to July at the earliest. Now look at what yields did. The 10-year Treasury dropped to about 3.97%, a 4-month low. The 2-year fell to around 3.38%, the lowest since August 2022. Hot inflation data and falling yields is not normal Goldilocks. That is stagflation pricing, persistent inflation expectations, decelerating growth. Fourth quarter GDP was only 1.4% annualized, barely above stall speed. The dollar index is down roughly 9.3% over the last 12 months. In that environment, capital moves into hard assets, not just financial claims, not just growth stocks, assets where you cannot print more with a keyboard. Gold did its job with a solid 1.8% move. Silver did far more, 6.23%, because it is both a monetary metal and an industrial input. It is sitting on top of structural physical tightness. It has a much smaller market cap, so flows move it harder. The gold-silver ratio compressed to around 56 on Friday's close. Long-term average above 67. Typical silver bull peaks 35 to 45. At 56, you are nowhere near historical blow-off territory. Directionally, if this bull market continues, the ratio has more room to move in silver's favor. Segment 8, options expiry. When physical steamrolls, Gamma Friday was also options expiry. And even there, the structure broke the usual script. Silver's implied volatility via VXSLV around 72.8 in the 80-plus percentile of all readings. Annualized implied vol on SLV in the 99 to 103% zone versus realized around 37%. In other words, the options market was pricing 3 times the movement silver has historically delivered. Max pain projections, the strike where market makers lose the least, were clustered in the mid-80s. Silver opened at 87.75. It then ran to 94.27, blowing straight through max pain and putting a stack of 90-105 calls in the money. On a normal day, gamma hedging would tend to pin price near max pain. On Friday, the physical delivery dynamics were bigger than the options flows. Physical pressure overrode the financial structure. And options traders will remember that in the next cycle. They will price more risk into upside tails because the last expiry proved the metal can ignore their models. Segment 9, delivery math, 52.6 mel ounces versus 88.4 registered. Now to the heart of the Comex story, deliveries, as of Friday's close. 10,526 March. Silver contracts are standing for delivery. Each contract is 5,000 ounces. That is 630,000 ounces standing against 88,423,000 ounces of registered silver. In other words, the first wave alone has already claimed about 60% of the entire registered float. Delivery will play out through March 31st. Along the way, some contracts will be cash settled, some will flip via exchange for physical arrangements, some will just roll forward. But now look at the recent drain rate. January and February combined consumed roughly 74 million ounces through Comex delivery. That is about 84% of current registered consumed in 60 calendar days. The average has been around 785,000 ounces per day. If that pace continues and vault replenishment does not materially accelerate, registered silver will enter April substantially lower than it entered March. And remember the calendar. May 1st notice day lands on April 29th. The window between this March delivery and the next stress point is short. Yes, CME has emergency powers. They can order liquidation-only trading, they can raise margins, they can cash settle stubborn longs at a premium. Classical Comex default, as in the exchange fails and disappears, is not the base case. The base case is repeated interventions. But every tool they use to reduce physical delivery pressure trades credibility for time. The more often real metal seekers accept paper substitutes at higher and higher prices, the more the entire system admits. We are not the physical market anymore. We are just a pricing suggestion. Segment 10. Miners and equities. Leverage that hasn't woken up. The equity tape on Friday told its own story. The SIL ETF, a basket of silver miners, rose about 1.4% to 116.51. That is tiny compared to a 6.23% move in the metal. In a real commodity bull, you expect miners to move 2x the underlying. On Friday, the ratio was not even 1/4 of that. Two possible readings. Institutional money has not yet fully rotated into silver miners, which means there is a catch-up trade sitting out there. Or the market is pricing operational risk, especially in Mexico with cartel violence and permitting issues, and is willing to own metal exposure without taking full equity risk. A couple of names stand out. Pan American Silver, up about 4.6% to 68.36, near its 52-week high. It just printed record full-year net earnings around $980 million and $553 million free cash flow in Q4 alone, after absorbing Mag Silver and its Juanicipio mine. At these prices, the company is a cash machine. First Majestic, trading in the high 20s to low 30s, up more than 400% year-on-year. Consensus targets around 2650 are already below spot. Models built on mean reversion silver are getting left behind. Hecla up marginally with strong balance sheet improvement and gold exposure diluting pure silver beta. The miners are telling you two things at once. The cash flow leverage is real at 90+ silver. Institutions are cautious about jurisdiction and volatility and have not gone all in yet. That gap between metal and miners is itself an opportunity, or a warning, depending on how you read the risk. Segment 11. The honest bull and bear cases. You deserve both sides laid out clean. Bull case. Registered inventories have fallen from 167 million ounces in October to about 88 million now. Comex has just run two of the most intense delivery months in its history. The swap rate and carry-adjusted basis have been flashing sustained physical scarcity. China and India are literally changing rules to defend physical metal. Samsung and other industrial giants are locking up multi-year mine output off exchange. In that world, the idea that silver should calmly trade at old levels while everything else reprices is fantasy. Bear case. Implied volatility near 100% means this market can just as easily print $65 on a reversal as it can print 100 on a spike. March deliveries could resolve smoothly via cash and EFPs, taking the drama out of the narrative and deflating speculative premiums. A real recession, with GDP going negative, could slow solar build-out and industrial demand just long enough to ease immediate shortages. Every emergency tool CME uses, from margin hikes to liquidation only, can and will suppress panic in the short term. Both cases agree on one thing: the exchange probably does not default in the Hollywood sense. The real question is price, not survival. How high does silver have to go for shorts to stop rolling and start surrendering? Physical holders to part with inventory. Arbitrage to become genuinely profitable again. That is repricing, and repricing is already in progress. Segment 12, where this leaves you, here's the structural picture as of Friday's close. Silver 93.66, up 6.23%. Gold 5,278.20, up 1.82%. Gold-silver ratio around 56. Registered silver 88.4 million ounces. 10,426 March contracts standing 52.63 million ounces, about 60% of the deliverable float already spoken for. Registered down by almost half since October. Total Comex inventory still falling even on a day when registered rises. Swap rate inverted, around minus 2.8% for 4 consecutive months. Carry-adjusted backwardation in place since October 2nd. Shanghai implementing its second major silver intervention in weeks, on the same date as Comex first notice day. US PPI running hot, yields falling, GDP near stall, dollar down almost 10% year-on-year. The macro backdrop that historically favors scarce hard assets over paper, that is the tide. Since October 2nd, registered has been falling, swap rates have been inverted, carry-adjusted basis has been negative. Friday's Vault report is not an exception. It is one more step in the same direction. This is financial education, not advice. Do not copy trades. Do not gamble on leverage because you watched a bullish video. Do this instead. Pull the CME warehouse report yourself. Check the swap data. Read the Shanghai notices. Look at how often registered gets topped up and how often metal just walks out the door. If you verify the data with your own eyes, you will not need anyone to tell you what is happening. The numbers will do the talking, and once you see it, you cannot unsee it.